Good evening, everyone. Today we'll start with Unit 2 of um, the Banking Specialization, Master of Business Administration, 4th semester, subject Financial Institutions and Market. We'll start with, we already completed Unit 1 video. We are going with Unit 2 now. Unit 2 covers 8 topics: money market, bond markets, foreign exchange market, pension funds, mutual funds, securities market, mortgage, and derivatives market. Money market. Money market is a trade in short term debt investments. At the whole level, it involves a large volume trade between institutions and traders. What actually money market does is actually it is a short term a debt instrument market, which means if in case some corporate have fund surplus and other corporate is having fund deficit, then this market through various instruments helps assists to the funds to flow from surplus to deficit area. Then instruments of Indian money market are call and notice money market. Call money market is any market above 14 days loan, but it is always short term and not more than 3 months. Notice market is notice money is less than 14 days. Commercial bills are the are promissory commercial bills are bills bill of exchange accepted by commercial banks. Then treasury bills are T bills. They are government approved bills, government security, government guarantee backed bills. Commercial papers are promissory notes issued by corporates to raise short-term funds. Certificates of deposit are the certificate given by corporate in case of deposit taken from public. Interbank participation certificate is when there is participation by banks in while giving funds to other banks. Repo instruments are when securities are traded and on a repo rate. And intercorporate deposits are deposits from one corporate to another. So these are the instruments. What are the features of Indian money market? It is a wholesale market. It is short-term market, always short-term market. A limited participation. Retail investors don't participate in the money market. No formal place. It is wholly traded on electronically and through. There is no formal place of a money market. There are no brokers involved. There is no integration of services. No single market. So it is diversified market. Indian money market can be divided into two parts: organized market and unorganized market. Unorganized market consists of indigenous banks, money lenders, and NBFCs. NBFCs as non-banking financial institutions. An organized sector consists of RBI, commercial banks, and cooperative banks. These are the players in Indian money market. Commercial banks can be classified into scheduled and non-scheduled banks. Scheduled banks are foreign banks and Indian banks. Then Indian banks are divided into public banks and private sector banks. Cooperative banks can be are divided into three levels, that is state cooperative bank, district cooperative bank, and primary credit societies. So this is the these are the elements of Indian money market. Bond market. Bond market, also debt market or credit market, is a financial market where participants can issue new debt known as primary market or buy and sell debt securities known as secondary market. This is usually in the form of bonds, but it may include notes, bills, and so on. Regulations, SEBI, RBL, SEBI guidelines, RBI guidelines, and Department of Corporate Affairs guidelines. These are regulators, and so there are three regulators to bond market: SEBI, RBI, and Department of Corporate Affairs. Then market segment: issuers, instruments, and investors. So when we talk about market segment, the sovereign issuers are central government and state government, and they use the instruments Government of India dated securities, treasury bills, state government securities, index bonds, zero coupon bonds. Investors are RBI, development financial institutions, and banks. And when public sector banks are the market segment, then public sector banks are government agencies and state bodies, public sector undertakings, commercial banks, and development financial institutions. Instruments are government guaranteed bonds, PSI bonds, debentures, and commercial papers, certificate of deposits, debentures, and bonds. And pension fund investors are pension funds, financial institutional investors, and corporates. In the private sector, we have corporates and private sector banks. Corporate issue bonds, debentures, commercial papers, SPNs, promissory notes, that is special promissory notes, floating rate notes, FCDs, PCDs, and ZCBs, that is zero coupon bond, flexible certificate of deposits, and these are there. And then private sector banks, they issue bonds, debentures, and commercial papers, and the investors here are individuals, provident funds, and insurance, trusts, mutual funds, etc. So money market, what are the features or instruments? Money market is a fixed maturity market. Money bond market is a fixed maturity market because bond is a loan, and loan has fixed maturity. There's claims on income, so secured market. Claims on assets, so they do have securities in the form of assets. Control, there is control in the saying of the when the creditor grants loan to any corporate, then they do have control and saying over various decisions of the company. And call features are there: long-term maturity period, fixed income, safer than the equity investment because there's fixed income attached to bonds, lower return than equity, and well-regulated market. So these are the features of a bond market. And then Indian debt market can be divided into money market, government securities market, and corporate bond market. Money market are instruments usually with less than 1 year maturity, that is tri-party repos, certificate of deposits, commercial papers, treasury bills, and cash management. Government securities market is like G-SECs, government security bonds, and state development loans. And when we talk about corporate bond market, it is corporate bonds, public sector undertaking bonds, and perpetual bonds. So these are the components of Indian debt market. Let us learn about foreign exchange market. Foreign exchange market is a market in which foreign currencies are bought and sold. The buyers and the sellers include individuals, firms, foreign exchange brokers, commercial banks, and central banks. Then foreign exchange market consists of central banks, institutional investors, commercial papers, commercial banks, brokers, individuals, and companies. Central banks, brokers, commercial banks, exporters, importers, tourists, investors, whosoever is dealing with foreign exchange can be participant in foreign exchange market. Features of foreign exchange market are 24 hours trading, 5 days a week. This is a market which never closes down. Lower trading cost, a highly leveraged market, there's high risk involved. Transparency, there's huge transparency of rates, access from anywhere in the world. Superior liquidity because there's free flow of funds. OTC market, over the counter market, there's no exchange, traded market, it is over the counter market. No physical transfer of money, actually no physical transfer money takes place. It is through digital transfer, and it is a global market, the market which is available in each and every part of the world, and no physical market. So there's no physical market, it is party to party market, OTC market. Then for functions of foreign exchange market are currency conversions, currency hedging, that is risk mitigation, currency arbitrage, trading of the two currencies when there is price difference, interest arbitrage, and currency speculation. Participants are international banks, traders and investors, dealers and brokers, investment banks, central banks, and arbitrageurs. Foreign exchange rates are a bid rate and ask rate. A bidding rate is buying rate, and ask rate is selling rate. Then types of transactions in foreign market are spot, transaction next day, forward, future, options, and swaps. When we talk about transaction next date is T plus 1, spot is T plus 2, forward is T plus N when N is fixed, that the rate date of transaction is fixed. Future is T plus N when N is not fixed, but there's a range of time period when this can be executed. Options, you have call and put option where you get an option to buy or sell securities, and swaps are swapping the liability or the liability of or obligation of one party with the other. Two types of quotes of foreign currency are direct quote and indirect quote, and spread is called as ask price minus bid price in case of direct quote, and spread is bid price minus ask price in case of indirect quote. Foreign exchange market, determinants of spread are currency being traded, volume of currency being traded, and nature of organization making quotes. Forward contracts versus future contracts. Forward contracts are over-the-counter contracts. Future markets are exchange traded. Forward contracts contain counterparty risk, whereas future contracts are exchange assumes risk. And terms are changeable in case of forward contracts. Terms defined by exchange in case of future contracts. Poor liquidity in case of forward contracts, and high liquidity in case of future contracts. Few players are there in forward contract, and there are many players in future contracts. No margins in forward contract, and margins are there in future contracts because they are exchange traded. Relationships do exist in case of forward contract, and price transparency is there in future contract. And skills to structure, and in future market there are standard products because they are exchange traded. Now, let us talk about pension funds. Pension funds are investment pools that pay for employee retirement commitments. Funds are paid by either employees or employers or both. Corporations at all levels of government provide pensions. The fund managers invest these contributions professionally. Then features and benefits are guaranteed income and pension. Long term, it is well structured, extremely low cost of investment, choices of investments are huge, mobility of payment is there, convenience is there, tax benefits are there, liquidity issues can be sorted out, vesting age, accumulation duration, payment period, surrender value, maybe debt based or equity based. So they can be debt based with fixed income securities, or income based on the investment in the equity market, which can lead to further rise of the return on the basis of the changes in the market rates. So definitely equity market is riskier than debt market, because debt market consists of fixed income securities, and equity markets are variable income securities on the basis of the market fluctuations. What are the types of pension funds? There are 7 types. Defined contribution pension funds, where your contributions defined benefit pension funds, where your benefits are defined. Pay as you go system, you can pay whenever you want and you can get the return on the basis of the contribution made. Funded system, participating pension plans, and unit linked pension plans. Funded systems are the systems where they're funded by employer and employee. Participating pension funds are where the various players are participating, and unit-linked pension plans, and also the investor in participating pension plan can make changes on the various instruments on which the fund is invested. Unit-linked pension plan is basically investment in mutual funds on unit-linked securities through the pension funds. Then Pension Fund Regulatory Development Authority, PFRDA, is a statutory body, is the pension regulator of India, which was established by Government of India on 23rd of August 2003 and was authorized by Ministry of Finance, Department of Financial Services. Upon the introduction of PFRDA bill by Government of India in the Parliament of India and the subsequent passage of the PFRDA Act in 2013, the authority became a central autonomous body. What are the functions of PFRDA? It regulates NPS and pension schemes to which PFRDA Act applies. It establishes, develops and regulates pension funds, protects the interest of the pension fund subscribers, register and regulate intermediaries, approve schemes, terms and conditions, and laying down norms for management of corpus of pension funds, establish grievance redressal mechanisms for subscribers, promote professional organization connected with the pension system, settle disputes among intermediaries and also between intermediaries and the subscribers, train intermediaries and educate subscribers and the general public with respect to pension, retirement, savings, and related issues, regulate the regulated assets, call for information, conduct inquiries, investigation, and audit of intermediaries and other entities connected with the pension funds. So these are the functions of PFRDA. Let us go to mutual fund. Mutual fund is a type of financial vehicle made up of pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Types of mutual funds are public sector mutual funds and private sector mutual funds on the basis of ownership. When the ownership, 51% ownership of the mutual fund is held by the government body, then it is public sector fund, and when it is held by the private body, it is private sector fund. Then open-ended fund, closed-ended fund, and interval schemes. Open-ended funds are open for subscription throughout the year. Closed-ended funds have a definite subscription period. Interval schemes are open for subscription within time interval. Then basis of portfolio, income funds, which gives you regular income, so they invest more on debt instruments. Growth funds, which give you capital appreciation, so it is based on equity funds. Balanced or conservative funds are income fund mix of equity and debt. Stock and equity funds, bond funds, specialized funds. When we invest in certain specialized sector, it is specialized fund. Leveraged funds are more on risk funds. Taxation funds are which give you tax benefit, and money market mutual funds invest in money market. And on the basis of location, there are domestic funds and offshore funds, and others are funds of funds, means funds based on the mutual funds. Loan funds, funds based on certain loans and interest rates, and non-loan funds are funds which are not based on an interest rate or loans. And securities market is where trading of stocks and bonds takes place. Securities market are industrial securities market and government securities market. In the industrial securities market are new issue market, that is primary market, and secondary market. Secondary market is a stock exchange. Primary market is a market where securities are issued for the first time. Secondary markets are of two types: organized security market and over-the-counter market. Organized security markets and over-the-counter markets can be divided into bonds, equities, and preference shares. Then government securities market is over-the-counter market. It consists of new issue market and secondary market. It mainly deals in the government securities like tree bills and government bonds. Securities market, new issue market, refers to the market in which the securities are issued for the first time. Types are initial public offer and follow-on public offer, FPU and IPU. IPU means when a company is coming with the securities for the first time to the public, and FPU is when already a company which is having its shares issued to the public is coming up with a fresh issue of shares. So then functions are preliminary investigative functions, services relating to issues, underwriting functions, and distribution channels. Methods of floating securities in NIM, that is new issue market, are issued through prospectus, issued through IPO, issued through offer for sale, issued through placement of securities, issue of bonus shares, issue of right shares, issued through stock options, and issue through book building process. Then problem of a new issue market are scarcity of funds and lack of mobility, risks involved in new issues, reliance on private or financial institutions, unnecessary issue expenses, high par value, involvement from intermediaries. Methods of marketing securities: public issue by prospectus, offer for sale, placement method, tender method, OTC placement, right issue, and bonus issue. We've already discussed all these things in the previous module. Secondary market is a market to which already issued securities are traded between investors. Features are already issued shares are traded between investors and investors. Facilitates liquidity of securities. Comes after primary market. Aids in financing the industry. Acts as a barometer of the economy. Ensures a fair and safe dealing. It has particular place and locations. The Bombay Stock Exchange, National Stock Exchange are the examples. Computerized market do not directly lead to capital formation, but it leads to mobility of shares. Well-regulated market. The role and functions and roles of the secondary market are buying and selling of already issued securities, fair and transparent trading, investor and participants education, safeguarding investors' interest, check into the fraud and malpractices, low cost of transaction, barometer of economy, dissemination of information, determination of market shares. Now, there's differentiation between primary market, new issue market, and secondary market. Stock exchange, securities traded, sale of securities by new companies or new securities, new issues of securities by existing companies are sold to investors in primary market, whereas in trading market, trading of only existing securities takes place. Buying and selling, only buying of securities takes place in primary market. Securities cannot be sold there. Both buying and selling of securities can take place in the stock market exchange. Purpose: the securities are issued by the company directly or through an intermediary. Ownership of existing securities exchange between investors. Company is not involved at all in case of secondary market. Capital formation, flow of funds is from the savers to investors. That is, primary market directly promotes capital formation, whereas secondary market enhances liquidity of securities. That is, the secondary market indirectly promotes the capital formation. Price determination, price of securities are determined by management of the company in case of primary market, whereas prices are determined by demand and supply of the securities in case of secondary market. Location, there is no fixed geographical location of IPO, that is primary market, and they're located at specified place as the secondary market. Let us talk about mortgage market. Mortgage loan, or simply mortgage, is used either by the purchasers of real estate to raise funds to buy real estate, or alternatively by existing property owners to raise funds for any purpose while putting a lien on the property being mortgaged. It is actually a fund which is required to buy any property or a real estate. And types of mortgage market are primary mortgage market and secondary mortgage market. Primary mortgage market is where the securities are issued for the first time when it comes to, but the securities are backed by the real estate. And in case of secondary market, the already issued securities are traded. Now, mortgage market, the secondary mortgage market. In primary mortgage market, lender and borrower, and secondary market, financial intermediaries and mortgage investors. So the transaction between mortgage lenders and borrowers takes place in primary market. In case of secondary market, takes between financial intermediaries and mortgage investors. Derivatives market is a financial market for derivatives, financial instruments like future contracts or options, which are derived from other forms of assets. The market can be divided into two, that are for exchange traded derivatives and that of over-the-counter derivatives. Then exchange traded derivatives are of two types: commodities and financials. And commodities market consists of soft commodity, livestock, metals, energy, new commodities. And financial part consists of equity financials, currencies, and interest rates. So when we talk about soft commodity, it consists of crude palm oil, soya oil, orange juice, cocoas. Similarly, in metals, gold, silver, uranium, and tin. Energy, it's crude oil, natural gas, and heating oil. Livestock, cattle, and new commodities consist of plastics, weather, freight rates, and electricity. Then derivatives market consists of three parts. There are three types of derivatives: forward contract and future contract. We already discovered forward and future contracts. And options are of two types: buy option and sell option, that is a call and put option. And swaps, then when obligations are swap between the parties. And derivatives, their types are forward, future, options, and swaps. Forward options can be of two types: to option to buy, that is call option, and option to sell, that is put option. And swaps can be interest rate swap or currency swap. So with this, we come to end of unit 2, and thank you for your time. I hope you all enjoy the session. Thank you.